Imagine this. You build your business from the ground up. You put in long hours and you even skip vacations. Instead of paying yourself a salary, you just take money out as dividends. It feels smart, right? You don't need any payroll headaches, and maybe you can even get some tax savings. But years later, the CRA comes knocking, not for your company's taxes, but for your personal money, demanding tens of thousands of dollars back. This is exactly what unfolded in the case of Mario Turcotte versus the King. Hi, I'm Amandeep Singh, CPA, founder of Cloudiverse CPAs. Today, I'm going to share Mario's story and the lessons every Canadian business owner can take from it. Mario was the sole shareholder and director of Global Video Inc. Between 2001 and 2008, he pulled out about $166,000 in dividends, and at the same time, his company owed significant tax debts to the CRA, unfortunately. In 2017, the CRA issued an assessment under Section 160 of the Income Tax Act, making Mario personally liable for almost $45,000. That's tax plus years of interest. Now, here's where it gets interesting. Mario argued that those dividends were not actually real dividends. He worked full time for the company but never took a salary or a T4 slip. He just said that his accountant suggested that it was simpler to treat this withdrawal as dividend, and he followed that advice. So Mario said, I gave consideration. Those dividends were actually payment for my work. It sounds reasonable, right? But the courts have been very clear. Going back to the Supreme Court's decision in Newman versus MNR and later cases like Walowick in 2020 and Murphy in 2022. The rule is this: dividends are tied to share ownership, not to the work you put in. They are distributions of corporate profits, period. So even though Mario worked full time, since he chose the dividend route, he could not later reframe them as wages. The judge even said he was trying to do retroactive tax planning, and that's never allowed. Mario then tried another defense, prescription, or what most of us call the statute of limitation, which says, and that's what he argued, that more than 10 years had passed since the original judgment against his company, so the debt should be extinguished under Quebec law. But the Income Tax Act has its own rules. Section 160 says the CRA can assess at any time, and Section 222 says every time CRA takes collection action, the 10-year clock resets. In Mario's case, CRA tried garnishments in 2010 and 2011 and then assessed him personally in 2017, and each action restarted the limitation period. So the debt was very much alive. In the end, the court dismissed his appeal. Mario was found jointly and severally liable for his company's unpaid taxes. So what's the big takeaway here? As business owners, the way we pay ourselves matter. Dividend can be a great tool, but if your company falls behind with CRA, unfortunately, those dividends can turn into a personal liability. Once dividends are declared, they cannot be rebranded as salary later on. At Cloudiverse CPAs, we help clients avoid these exact situations. We look at your compensation mix, balancing dividends, salary, and bonuses, and make sure your taxes are managed properly. We help you plan ahead so you're not blindsided years later with a huge CRA bill. Mario's story is a cautionary tale. He thought he was saving time and money with a simple approach, but it unfortunately ended up costing him dearly. With the right planning and advice, this could have been avoided. If you're a business owner paying yourself in dividends, or if your company has any outstanding tax balances, let's talk. A small adjustment today can save you from a very big tax headache tomorrow. Thanks for watching. Don't forget to subscribe for more real Canadian tax stories that every business owner should know. I'll see you in my next video. Bye.